upturn in the economy would help, but could it, like in a period of 5 years or 10 years, could it correct the situation if there was an upturn in the economy, that interest rates were coming in? In other words, our interest rates went from near 10% to like 1 and 2% on our regular money that we set aside. Do you feel that the stock market going up on this, parallel universe or whatever would also correct the situation, or is that far from being true?
Well, a more vibrant economy would have several effects. Number one, it would help to lift equity values, but presumably because earnings would fill in under the stock market, you get an upward trajectory to asset values for the equity markets. And to the extent that your portfolios are exposed to equities, you would benefit from that. The secondary benefit that you would have from an economy that had less slack in it would be the propensity for the Federal Reserve to raise short-term interest rates. In addition to the very unusual condition of having the equity market underperform or perform in line with the bond market over the last 20 years, the other very unusual situation you're confronted with is that the Fed has taken the cues from the economy to use this as an opportunity to bring interest rates to essentially 0%. And that saps a tremendous amount of income out of the economy, in addition to trying to stimulate it and provide incentives for the banks. So if you're on a fixed income, or if you're managing a pension, for example, the income into your portfolio is going to be much less than it would otherwise. So an expanding economy would tend to incentivize the Fed to raise interest rates, and that would not only help the equity side, but also perhaps helps the short-term bonds in the portfolio to provide a higher level of income. Keep in mind, though, that in a rising interest rate environment, any longer-term debt that you would have exposed in the portfolios would tend to come under pressure, because bond prices move in the opposite direction of interest rates. So yes, an improving economy, I would say, had two benefits: higher interest coming into the portfolios, potentially higher equity values, but on the other hand, the longer end of the portfolio would be depressed. But as far as we can tell from the work that we've done, we still see a tremendous amount of slack in the economy with 10% unemployment rate. We still have too many homes that are sitting vacant. We still have a lot of underutilization of assets and very importantly, you still have, for the first time since the 1930s, the private sector liquidating debt as opposed to taking on debt, which is an enormously powerful phenomenon that tends to produce downward pressure on prices, not upward pressure on prices. So there's some significant headwinds to getting to that next easy step of having expansion. And I think that, while in the past you've had recessions and then quick recoveries, this is obviously a very different situation for those reasons.
So what I heard was the employment rate has to be better, the unemployment rate has to drop, the interest rates have to go up, and people have to be willing to borrow money.
Yeah, I would reverse that. I would say that probably if there was one data point that is most important in this entire calculus, is whether or not the private sector in the United States, that's households, businesses, large and small, banks, were willing to expand the amount of borrowing that they engage in. And that there's a complex reason for that, but it simply relates to the fact that the stock of money in the country, and hence the inflation rate in the country, and the appreciation to a certain extent of asset prices, is directly linked to that. So it's not a coincidence that for 75 years you've had rising debt, but also rising stock market values, housing values, etc., and so forth. And when you don't have an increased debt in the society, you're also going to tend to have very soft prices. That was the trap that the Japanese got involved with 20 years ago, and they found it more difficult than they originally thought to get out of it. And so it's with that kind of sober assessment that we've undertaken the effort to try to get a fair understanding of what the current conditions are, because it doesn't mean because there are times to be invested more heavily in cash, short-term bonds, those kind of things from our point of view, and there are other times to take risk. And right now we're at that reflection point where we're choosing to be a little bit more cautious in our approach.
Okay.
Thank you.
Any other questions?